daily source for market intelligence and financial analysis. Today is Saturday, August 16th, 2025, and we're bringing you the intelligence brief for yesterday, Friday, August 15th. Okay, let's unpack this. Friday, August 15th was, well, it felt like a day where global markets were really pulling in multiple directions. We saw investors trying to make sense of a real mix, some surprisingly firm U.S. economic data, a few, eyebrow-raising corporate earnings, and of course, that ever-present background noise of global uncertainty. Just to give you the broad strokes, U.S. equities were mixed. The S&P 500 and NASDAQ slipped a bit, but the Dow Jones actually managed to eke out a gain. And there was a striking contrast, too. Japan's Nikkei 225 surged to a fresh record, which is pretty amazing, while Hong Kong's Hang Seng fell almost 1%. Elsewhere, commodities were broadly weaker and the U.S. dollar declined.
Yeah, what's fascinating here is how these movements weren't just, random noise. They really reflected very specific forces at play, like shifts in investor sentiment, challenges unique to certain sectors, and, well, differing regional catalysts. It truly was a day where you really needed to look beyond the headlines to get the full picture, to understand the underlying currents.
Right, understanding those currents is key. And speaking of that, today's deep dive comes with the support of NextSight, the global intelligence team behind these insights. Through their open source OSINT platform, Site Connect and OSINT, that stands for Open Source Intelligence, meaning they collect and verify data from publicly available sources. They gather, check, and structure information from all sorts of places, giving clients an edge in decision-making. So whether you're tracking market trends or, say, assessing geopolitical risks, they can tailor intelligence right to your needs. You can learn more at www.next-site.com. Now, let's dive deeper into the U.S. market first, because this is where it gets really interesting. How did the Dow manage to pull off a gain while the S&P 500 and NASDAQ, those other big indices, slipped? What was the driving force there?
Well, the Dow's unexpected rise, it gained 0.1%, was mainly because investors were rotating into more defensive healthcare stocks. The key catalyst there was Berkshire Hathaway, Warren Buffett's firm, disclosing a really sizable stake in United Health. That news alone caused United Health stock to surge almost 12%, and, well, that lifted the entire healthcare sector, giving the Dow that little positive push.
Wow. Okay, so a single significant investment by a major player like Berkshire Hathaway really moved the needle for the Dow, even as the broader market saw declines. That's quite a concentrated effect.
Exactly.
It really underscores how sometimes, a big institutional move can create these unique, almost counter-market movements in specific large-cap stocks. It's a critical reminder for investors not to judge broader market health just by looking at one index.
Precisely. And in contrast to that, the S&P 500 slipped 0.3%, and the NASDAQ Composite, which is, as you know, heavily weighted towards technology, lost roughly 0.4%. That was mainly because the tech sector faced a pretty significant drag. Semiconductor names in particular were hit hard after Applied Materials delivered some downbeat guidance for their upcoming fourth quarter.
Okay, Applied Materials. What was it in their outlook that spooked investors so dramatically, especially when their Q3 results actually beat expectations? I saw revenue was, $7.30 billion, and EPS 2.48 cents versus an estimated $2.36.
Yeah, that's right. Their Q3 results were strong, but the forward guidance definitely sent shiver through the market. The downbeat outlook was primarily due to weak Chinese demand, but also, importantly, this uncertainty around President Trump's tariffs and export license delays. So Applied Materials shares fell almost 13% just on that news. It really illustrates how much geopolitical factors and shifts in global demand are influencing even strong companies right now.
Definitely. And beyond these individual corporate stories, U.S. markets also digested a mixed set of macro data, didn't they?
They did. We saw strong July retail sales, which really reinforced the resilience in consumer spending. That's generally a positive sign for the economy. But on the other hand, the University of Michigan Sentiment Survey unexpectedly softened, creating a bit of a tug of war in the economic signals.
Oh, okay, so mixed signals there.
Yeah, and stepping back, this mixed data just fueled a renewed debate over the timing of Federal Reserve rate cuts. It creates a pretty complex scenario for chief investment officers, CIOs, who need to stress test their portfolios against both a higher for longer interest rate environment and the possibility of an accelerated easing path down the road.
That's a really vital point. The future direction of interest rates is still very much up in the air, and it just impacts everything, doesn't it?
It really does.
So while the U.S. market wrestled with its domestic data points, the global picture offered a striking set of divergences. Let's look at how Asia and Europe fared.
Right. So in Asia, the standout was definitely Japan. Its Nikkei 225 surged an impressive 1.74% to a fresh record close of $43,392.0. This is buoyed or, lifted by two main things. A weaker yen, that's the Japanese currency, trading near 147 yen to the US dollar, which really helps Japanese exporters. And also stronger than expected domestic Q2 GDP, meaning their economy grew more than anticipated. The broader TOPIX index also gained a solid 1.63%, showing pretty broad strength across Japanese equities.
That's a powerful rally for Japan. Quite the contrast. But you mentioned Hong Kong had a very different day.
Yes, a stark contrast indeed. Hong Kong's Hang Seng Index fell almost 1%, 0.98% to be exact. This was largely due to the disappointing Chinese retail sales and industrial output data, which reflects these continued concerns about China's economic recovery.
Yeah.
Interestingly, though, the Shanghai Composite, despite those weak figures, managed to rise 0.83%, probably amid speculation of additional stimulus coming from Beijing.
Interesting divergence even within China-related markets.
Exactly. And this raises an important question for you, the listener. With this weak Chinese data pressuring Asian equities and commodities, what does this really tell us about broader global demand? Assets linked to Chinese demand, things like semiconductors, luxury goods, iron ore, they remain particularly vulnerable to any policy disappointments or continued economic softness there.
That's a crucial consideration for anyone watching global trends. Absolutely. And what about Europe? Did it follow the U.S. lead or more like Asia?
Europe had a more mixed, maybe cautious day. The pan-European STOXX 600, which tracks broad European stocks, it edged lower by just 0.1%. It felt like it was effectively taking a breather after a pretty good two-week rally. Germany's DAX edged down just 0.07%, with some of the technology heavyweights like ASML tracking U.S. semiconductors lower, similar to what we saw on the NASDAQ.
Right, that makes sense. Any specific companies in Europe that really stood out with significant drops?
Yes, there were two notable decliners that caught my eye. First, the Copenhagen-listed jeweler Pandora slumped a significant 18.4% after posting weak sales. That erased approximately $3 billion of market value in just one day. Huge drop.
Wow, 18.4%?
Yeah. And then Standard Chartered, the big bank, fell 7.2% as a U.S. lawmaker called for a probe into its alleged role in facilitating Russian oil flows. So across the board, sector breadth remained pretty narrow in Europe. That means only a few sectors were doing well. Healthcare and staples led, while cyclicals, the ones more tied to the economic cycle, lagged behind.
Okay, so a lot happening beneath the surface there, too. Now, beyond the stock markets, the movements in bond yields, currencies, and commodities, they always tell another layer of the story. What happened in the rates market, and how did that influence currencies?
So in the rates market, yields reflected what we call a modest bear steepening. It's a bit technical, but it basically means long-term bond yields rose a bit more than short-term yields. Specifically, U.S. 10-year Treasury yields rose about 3 basis points. Rounded basis point is 0.01%, up to 4.32%. And the 2-year yields edged up 2 basis points to 3.76%. This narrowed what's called the 2S10's inversion.
Right, the inversion, where short-term rates are higher than long-term.
Exactly. And that inversion often signals market concerns about future growth or maybe even a potential recession. So seeing it narrow suggests maybe a slight easing of those worries. This uptick in yields was largely a reaction to that robust U.S. retail sales data we talked about, which sort of tempered or reduced expectations for immediate Fed rate cuts. European sovereign yields also firmed up a bit, with German bond 10-year around 2.79% and UK gilts near 4.70%.
Okay. And what about credit and volatility? Those are often key indicators of market sentiment, risk appetite.
Right. Well, credit spreads continued to compress, meaning they got tighter. For example, the ICE BofA investment-grade OAS fell to 77 basis points, and the high-yield OAS dropped to 2.89%.
So OAS, that's the option-adjusted spread, the extra yield for holding corporate debt.
Exactly. It's the extra yield investors demand for holding riskier corporate debt compared to safe government bonds. Both investment-grade, or IG, and high-yield corporate bonds are now paying less extra yield, hitting their lowest levels in about a month. This generally indicates investors are feeling pretty comfortable about corporate health, and equity volatility remained notably subdued. The VIX, often called the market's fear gauge, closed below 15 at 14.83.
Below 15, wow.
Yeah, this indicates what we sometimes call complacent equity volatility, meaning investors aren't really bracing for big market swings right now. What's fascinating here, though, is that credit risk premia continue to tighten so much. For risk managers, this is a clear signal to perhaps evaluate counterparty credit exposures and monitor flows into high-yield funds, because there's really very little compensation baked in for potential macro or geopolitical shocks at these very tight levels.
That's a great point. Complacency can be risky. Okay, moving to currency movements. What happened with the dollar?
The U.S. dollar index, or DXY, which measures the dollar's value against a basket of 6 major global currencies, it actually declined 0.4% to 97.86. That marked its second weekly drop in a row.
Okay, second week down.
Yeah, and this likely reflected investors pricing in a slightly higher chance of Fed rate cuts, especially following that softer consumer confidence data we mentioned earlier. As a result, the euro strengthened to €1 equals 1.1688 cents, and the yen appreciated modestly to roughly 147 yen to the dollar. Zooming out a bit, for CFOs and Treasury teams listening, the dollar's 2 consecutive weeks of weakness means, those with significant euro, yen, or sterling exposures might want to consider adjusting their hedge ratios ahead of upcoming central bank meetings just to manage that currency risk.
That's definitely actionable advice for our listeners managing those exposures. So what was the picture like in the commodities space? You mentioned generally weaker earlier.
That's right. Commodities were broadly weaker on Friday. WTI crude, that's a key U.S. oil benchmark, fell 1.3% to $63.13 a barrel. And Brent crude, the international benchmark, slid 1.1% to $66.10 a barrel. These losses seem to follow a 3 million barrel build in U.S. crude inventories, which suggests maybe less demand than expected, and also those lingering global demand concerns, partly tied back to that weak Chinese industrial data again.
Right, the China connection keeps popping up.
It does.
Yeah.
Natural gas, however, bucked the trend. It actually rose 2.83%, mostly on forecasts for above normal temperatures, which boosts demand for cooling.
Okay. And the metals. Gold has been such a big story this year. How did it fare?
Indeed, gold has been strong. It held pretty steady near $3,336 an ounce on Friday, and importantly, it remains up nearly 27% year-to-date. This impressive performance is supported by what's called real yield compression, basically. Bond returns, after accounting for inflation, are becoming less attractive, pushing investors towards gold. And it's also supported by geopolitical hedging, as gold is often seen as that safe haven asset during times of uncertainty.
Makes sense. What about other metals?
Silver and copper both declined. Copper specifically saw worries over Chinese demand flare up again, given its heavy use in industrial activity and construction. And iron ore sank nearly 5%, also due to concerns about weak steel demand, particularly out of China.
So really a mixed bag across commodities, but definitely pressure on those industrial metals linked to global growth, particularly China.
Precise.
And just a reminder for everyone, if you need intelligence that doesn't just inform, but actually guides your next move, Next Sight can help. Their work supports investigators, executives, and analysts worldwide with targeted, actionable insights delivered with clear reliability ratings so you know exactly what's solid and what's still developing. Finally, let's talk about something that touches many of our lives directly. Real estate. What's the latest there, and then what can we expect in the coming week that might shake up these markets?
Sure. In real estate, the main news is that mortgage rates in the U.S. continue to drift lower, albeit slowly. The average 30-year fixed-rate mortgage was 6.58% for the week ending August 14th, down just slightly from 6.63% the previous week. And the 15-year mortgage rate fell to 5.71%, which is actually its lowest level since May.
Okay, still high historically, but trending down a bit.
Right. And for CFOs and Treasury teams, this slight easing opens maybe a small window to review debt issuance plans as slightly cheaper long-term financing becomes available. And generally, you'll want to keep a close eye on the upcoming housing data for any signs of a demand rebound responding to these slightly lower rates.
Good point. That sounds like a potential, maybe small, lifeline for the housing market. So looking ahead now, what key events should we really be watching out for in the week ahead that could impact all these markets we've discussed?
Well, markets are definitely entering what looks like a catalyst-rich week. Lots on the calendar. On Monday, August 18th, we have the PBOC loan prime rate announcement. That's the People's Bank of China setting their key lending rate. Very important for China watchers. Plus, we have other global central bank meetings in Sweden, New Zealand, and Indonesia.
Okay, busy Monday globally.
Then Tuesday, August 19th, brings crucial U.S. housing data. We'll get the NAHB Housing Index, which measures home builder confidence, plus building permits and housing starts, giving us a sense of future construction activity.
Very important for that real estate picture.
Exactly. Then on Wednesday, August 20th, we'll get the FOMC minutes from the July meeting. The FOMC is the Federal Open Market Committee, the Fed's policy-setting body. And these minutes, the detailed record of their discussion, could significantly reshape rate cut expectations based on what they were thinking internally back in July.
Ah, the minutes. Always closely watched.
Always. Also on Wednesday, the EIA Weekly Petroleum Status Report is due. That's the Energy Information Administration's report on U.S. oil inventories, so watch for oil price follow through there. Thursday, August 21st, will give us the S&P Global Flash PMIs across major economies, U.S., Eurozone, U.K., and Asia. These are purchasing managers' indexes, and they provide a very early look at economic activity for August, covering both manufacturing and services. Super timely data.
Right, the first glimpse of August activity.
Yeah. Plus, we'll also get U.S. existing home sales on Thursday. And then capping off the week, starting Friday, August 22nd, is the much-anticipated Jackson Hole Symposium.
Jackson Hole, always a big one.
Yes. It's an annual meeting of global central bankers held in Wyoming, and Fed Chair Powell is expected to speak. His comments there could potentially influence rate expectations significantly heading into the fall.
So a packed week indeed.
Definitely. And with volatility near multi-month lows, as we discussed, and credit spreads being so tight, risk assets remain quite vulnerable to any hawkish surprises from the Fed or central banks or, further evidence of Chinese weakness as these catalysts unfold next week. It's a lot to keep track of, but each one of these events really has the potential to move the market.
Absolutely. That wraps up the Friday, August 15th, 2025 intelligence brief delivered to you on this Saturday, August 16th edition of the Deep Dive. What stands out to you from all these interconnected movements we've talked about? What questions are now swirling in your mind after unpacking this complex day?
Well, I think this raises a really important question looking ahead. With so much data coming next week, key central bank decisions, crucial housing and manufacturing figures, Jackson Hole looming large, are current market valuations truly reflecting the potential for sudden shifts in sentiment or policy? How might this complacent volatility, where things seem relatively calm on the surface, actually be hiding a coiled spring, ready to react sharply maybe to the next piece of unexpected news?
A coiled spring. That's definitely something to mull over this weekend. Make sure you're subscribed on YouTube and Spotify, and please drop us a like, share, or comment. Your feedback really helps shape future deep dives. Have a great Saturday, and enjoy the weekend ahead.